Hello and welcome to the Weekend Investing Daily Byte of 6th of September. And the market finally, the floor gave away and the 25,000 mark was lost on Nifty. The large caps fell first, small caps resisted for some time, but then the rest of the market also followed suit. So to some extent, one can say that some sort of a correction has started. Whether it will go deep or whether it will stay shallow or whether it will spring back up very quickly is not yet known. Uh, the makeup of the fall was pretty even across sectors, as we will see, and the extent of the fall was nothing very serious to that extent. Uh, this is one change that we are doing at MI Evergreen. This is a CNX 200 strategy. There's a price change that is happening. In case you are interested in this strategy, please enter before 9th September. I'll talk more about this towards the end. And I'll also show you today when shocking performance data from CNX 200. You would never have guessed it or thought about it from this point of view, how uh, the skew due to the weights within the CNX 200 makes a huge difference to the performance and what you can do to improve on that. But first, please subscribe to the channel, and you can also click on the bell notification and try to motivate us with more subscriptions of the channel. Where is the market headed? So market, as I am showing on the screen, Nifty down 1.17%. There were three gaps that have been made since the beginning of the August crisis that we had. We've covered, gone and closed one of them today, and we are coming closer again to this 40-day moving average that we have on the chart. Uh, there is a potential that we will go down further also, but let's see. So basically, this breakout has been uh, proven to be a false one. The market could not sustain it there, although it did try twice on the previous 2 days, but today it has given away. Nifty Junior also cracked below the support, minus 1.36%. Uh, the next two major data points are, one is tonight in terms of jobs data from the US markets that has implications all over the world as well. And then there is in about 2 weeks time, less than 2 weeks time, the FOMC interest rate meet, which also is going to have impact global markets in a big way. So these are the two events that one can look for in this month, and that is likely why probably markets are bracing themselves ahead of those two data points. Mid caps also fell. Initially, they did open at previous highs, but during the day they collapsed back to this support at 21,675, down 1.37%. Small caps made a bearish and candle, had hit a new all-time high before doing so. So there was a reluctance in small caps to come down versus large caps, but eventually gave way and covered this gap that was created a day ago. Still, I would say small caps are doing much better than the rest of the market, although there is a lot of calls from various experts who say that large caps are the way forward from here on and not small caps. But small caps are right now much more resilient than large caps as of now. Bank Nifty was the real one which had a big move down, minus 1.74%. Bank Nifty worries don't seem to be ending. Everybody is talking about the poor deposits at the banks and the margins that is going to get squeezed because of that. So there is a lot of worry in the banking front. Uh, Although I was thinking, maybe rightly or possibly wrongly, that interest rate cuts would help the bond book of most banks, and that may cause a upward pressure on the banks. But there are other worries which are engulfing the bank index. Momentum trends, you can see the advances were really poor. So yesterday somebody had asked me, I must explain this chart more. So this is a CNX 500 chart. So 500 stocks, how were they moving today? So 111 stocks today on 6th of September have moved up, advances, and 389 have moved down, declines. And this, in some rough way, tells you the mood or the sentiment of the market. Whenever markets are sentimentally weak, you will see more red. Whenever they are more bullish, you will see more green. Whenever they are sort of even, like for last 4 days were, you will see this being almost similar on both sides. So today there was definitely a skew towards the reds, and hence the market was also down. FII small selling yesterday, minus 688 crores, and a good buying by DII. So overall, FII plus DII number continues to remain positive, and barring one day, the total institutional buying has been positive in total. If you see this, but yes, I mean, if let's see whether this one day sale by FIs is a flash in the pan, or does it become a continuous trend. Today's heat map was all red. There was no place to hide. Reliance down 1.89%, and the biggest bear today was State Bank of India. So State Bank of India, whenever it makes big moves, it is usually a start of a decent trend. So State Bank falling 4.4% uh, is saying a lot more than what actually overall market is saying. That there is some sort of a down leg that we are looking at. Uh, it is unusual that banks fall this big and then suddenly they come back up to more on the next day. That usually doesn't happen. But let's see where we go. ITC, NTPC, Reliance, Coal India, Infosys, all big names fell today and fell nearly 2% each. And you had SBI, which really uh, stood out with 4%. In terms of Nifty Next 50, also there was a lot of red. Uh, a lot of the uh, finance related the power finance and the RECs of the world also fell. IRFC fell. So there is potentially talk of no rate cuts in India, even if US cuts the rate, and that potentially is getting priced in here. Maybe Canara Bank, PNB all fell dramatically today. SBI Card was the only one which stood out with Marico, Zomato, some gains in Pidilite and ICICI GI. That was the only sort of gains. But other than that, even companies like Motherson and Bosch were not spared, along with SRF. So overall, a selling day. Again, not very clear if India will toe the line of interest rate cuts. If they don't, then obviously the market is going to get a bit disappointed. Sectoral trends: PSU banks hit the most, led by SBI, minus 3.6% single session. That's a deep cut actually. Public sector enterprise stocks at minus 2%. Energy, private banks, infra stocks all down more than 1.5%. Commodities, autos, IT, real estate down 1% and more. And pharma and consumption is where sort of the least hit happened, as they are sort of the defensive stocks where money rushes to during these falls. So entire day, full day, all sectors down. In the last 1 week also, barring a FMCG at plus 0.2, everything is down. So last 1 week is a complete washout. And uh, uh, while the month still looks good, let's see where this trend takes us to. This also, I want to mention here that there is this unbelievable confidence in the market right now that every fall will result in a equivalent recovery very soon. There will come one day when it won't happen so fast. So markets remain at all time highs, not even 50% of the months. If you go back and see, it will only be maybe like 30%. So we've had so many continuous months of all time highs that there can come a period where you may have a year or 2 years of some sort of a consolidation. So that, while really can't say when, how it will happen, but in your mind you should be prepared for that. That is the whole idea of this narrative. And PSU banks are really looking on the chart very, very scary. If this election day low gets taken out, then possibly that will point out to be a lot of weakness for this space. Indian Bank, Canara Bank, State Bank of India, Bank of Baroda, PNB all losing some big numbers there. Stock spotlight: Godfrey Phillips 2:1 bonus is the consideration. As I've shown you in previous videos, bonuses and splits are simply, accounting juggleries, money moving from reserves to share application. So nothing really earth shattering happens when you issue a bonus or a split, but markets love that. uh, and there may possibly is are other reasons why Godfrey Phillips is going up. We will not get into the reasons, but we've been riding this in some of the strategies, and it's up 12.3% even on a day like this. So that tells you the current strength in that particular stock. And it was sort of a range bound for almost 6-7 years before it broke out, and that really has caused a rocket like move in Godfrey Phillips. So now let's come to the topic of the day: shocking performance data from CNX 200. When I first saw it, I too was shocked, and I think you will be similarly shocked as well. So these are the top 20 weighted stocks of CNX 200 index. CNX 200 is the largest 200 stocks. Basically, everybody knows that. Uh, so this index has HDFC Bank as its highest weight at 7.4%, Reliance at 6.25, ICICI 5%, Infosys 4%, TCS 2.8%, so on and so forth. Uh, if it was equal weight, then each of these 200 stocks will have 0.5% weight. So the top 20 stocks also have 0.96 or more. So 0.5% is much lower down the hierarchy. And these top 10, 15, 20 stocks, top 20, so the 10% out of the 200 are 50% of the weight. So 10% stocks have 50% weight, and 90% stocks have 50% weight. That is the way the momentum, the CNX 200 index has been designed. So that is the basics that I want you to be clear. Now, pay very close attention because it can get confusing. The top 20 weights, as I mentioned, is 50%. But if I was to see the performing stocks, top 20 performing stocks of the last 1 year, their weight is only 8%. I hope you are able to appreciate this and get this point. Right now, the top 20 weighted stocks as per the index design is 50% weight. But if I were to calculate the top 20 performing stocks of last 1 year in this 200 list, their weight is only 8% of the index. Now, the average return of these 20 weighted stocks in the last 1 year is 43% on average. But if I were to take top 20 performing stocks of the last 1 year, their average is 184%. So please see where I'm going, that the average return of a high weighted stock is 43%. The average return of a performing stock in the last 1 year is 184%. Overall, the performance of the index is 38%. Okay. So now contribution to, not Nifty, it should be CNX 200. Now contribution of these stocks who have made average of 43% is about 16%. Whereas contribution of the performing stocks, because of low weights, they're, despite having an average return very high, is only contributing 14% to the CNX 200. So there is a bunch of stocks which are really performing well. They are contributing only 14%. There is a bunch of stocks, because of their heavy weight, and even if they are not performing so well, they are contributing 16%. Overall, this should be CNX 200. I'm sorry. CNX 200 performance is 38%. Now imagine how this Q can be solved with momentum strategies. So if you were to sort of, let's say, imagine that you have a mechanism where you're trying to find the best performing stocks in each month. You're trying to get in and get out of the best performance stocks. If not that 184%, you will have a significant portion of these stocks which will be there in your portfolio. And because you can keep an equal weight of those performing stocks in your portfolio, and they would be doing much better than the rest of the stocks of the portfolio, your overall outcome of the portfolio can be much, much better than the index. I hope you are able to follow this. If not, just write in the comments. I'll explain again. So MI Evergreen is something that solves this. It is a CNX 200 strategy that we have. It invests in the top 20 strongest stocks from this universe, and it allocates to these 20 stocks, and every month we have a rebalance, and if something needs to be changed, it gets changed. There is no bias at all. So this is something that we are wanting. Users who want to get away from this skewed weightage of CNX 200 into an equal weight top performance can come into this strategy. The strategy is actually going through a change from 9th of September. And in case you were interested in this, you can always come in to this strategy. That's all I have for this. And I want you to write on the comments what is your, thought process about this weight skew. And this is not just in CNX 200. This is in Nifty Next 50 also. This is in Nifty 50 top 100 stocks. This weighted skew really, really will screw you badly in years where those weighted stocks are not doing well, and only in those specific years where those particular weights will do really well will those indices really do well. If you see, even over a 5-year 10-year period, we have shown that CNX 200, because of these weights, will not be as good as a equal weight performance of all stocks. I'm not even saying 20 stocks. 20 stocks performance is definitely better, but even if you were to take all these 200 stocks and do equal weight, they will perform better. Thank you so much for watching. Bye.